BlackRock just told investors they can't have their money back. Is 2008 happening again? Every major financial crisis in history started the same way. Not with a crash, not with headlines, with a quiet decision, made behind closed doors, that nobody told you about. In 2008 it was banks secretly running out of money. In 2026, it's happening again. But this time the company locking the exit doors isn't some small regional bank. It's BlackRock, the firm that controls more money than the entire GDP of China. And what they just told their investors should send a chill down every American spine. You cannot have your money back. BlackRock's $26 billion private credit fund received withdrawal requests worth 9.3% of its total assets in a single quarter. BlackRock's response? They capped withdrawals at just 5%, blocking nearly half of investors from getting their money back. But it didn't stop there. Blackstone, another giant, saw a record 7.9% in redemption requests and had to inject $400 million of its own cash just to cover investor demand. Blueowl went even further, stopping withdrawals altogether and handing investors IOUs instead of cash. An IOU. From one of Wall Street's biggest firms. Let that sink in. So what exactly is private credit, and why should you care? After the 2008 financial crisis, banks were forced to stop making risky loans. So a new shadow banking system quietly emerged. Giant investment firms started collecting money from pension funds, university endowments, and wealthy investors, and lending it directly to businesses. This industry grew to over $2 trillion. And for years, it looked like genius. Until now. Financial experts are now drawing uncomfortable comparisons to the 2008 subprime mortgage crisis. Both systems relied on complex opaque financial products that were almost impossible for outsiders to value. The ghost of 2008 is quietly returning. Here's the terrifying part. Unlike public stocks, private credit assets don't trade on any market. Their value is determined internally using mathematical models. Which means a $1 asset could suddenly be revealed as a 60-cent asset the moment anyone tries to sell. The illusion holds, until everyone wants out at once. The numbers tell the real story. In the 6 months following the start of this crisis, Blackstone lost roughly a third of its market value. Blueowl dropped over 42%. KKR fell 32%. Apollo lost around 20%. And private credit defaults have now passed their 2008 peak, hitting a record 9.2%. The largest money managers in the world are simultaneously locking the exits. And the macro environment, oil above $100, rates staying high, growth slowing, is making every single one of these problems worse. You might be thinking, I don't invest in private credit funds. This doesn't affect me. Think again. These funds hold money from your pension fund, your insurance company, your university endowment. Financial systems don't eliminate risk, they just relocate it to where fewer people are looking. And right now, very few people are looking here. BlackRock, Blackstone, Blue Owl, Morgan Stanley, they all said the same thing to investors in 2026, you can't have your money back right now. If that doesn't remind you of 2008, nothing will. Subscribe to the Economic Order, because the real news is always in the details.